You finally crossed 200 grand and the IRS was waiting. It's renewed taxes, not a higher bracket. 3 separate surcharges that switch on the exact dollar you cross 200,000. Your payroll department never mentioned a single one. If you are a mid-career professional in your 30s or 40s, just hit that number. This is not a bracket problem. It is an architecture problem. The tax code buried 3 tripwires at $200,000. Most high earners walk straight into all 3 before anyone says a word. The math is uglier than any bracket chart will show you. Start here. A single filer earning exactly $200,000 in 2026 owes about $36,700 in federal income tax. Divide that by 200,000. Your effective rate is roughly 18.5%. Your marginal rate, the number people argue about, is 24%. That gap between 18.5 and 24 is the first thing most people get wrong. They hear bracket and imagine a ceiling that taxes everything underneath it. That is not how this works. You pay 10% on the first $12,400, 12% on the next tranche, 22% after that. The 24% bracket only bites the top slice. The overall damage is far smaller than the headline number suggests. If you want to understand what your paycheck is actually doing before someone else figures it out for you, hit subscribe. This is Salary to Strategy, and we build for people who trust numbers over narratives. So here is the trap. People misunderstand brackets. And because they do, they misunderstand what 200,000 actually is. It is not the bracket that changes at that line. It is 3 things nobody told you about. They change together, on the same dollar, in the same year. I call this the invisible stack. 3 separate charges piling onto your income at the exact same threshold, each designed by a different corner of the tax code, each invisible on your W-2 until you look for it. The bracket gets all the attention. The stack does all the damage. Let us build it layer by layer. The first layer is the additional Medicare tax. The rate is 0.9%. It applies to every dollar of wages above $200,000 for a single filer, not your total income, not your net income, your wages. The moment your employer pays you that $200,000 in first dollar, a new deduction appears on your paycheck. 0.9% on every dollar from that point forward through the end of the year. 0.9 sounds trivial. That is the design. It sounds like a rounding error. It is not. Here is what makes it strange. There's no employer match on this one. Every other Medicare and Social Security tax you pay gets split between you and your employer. Not this one. The additional Medicare tax is yours alone. Your employer withholds it. Your employer contributes nothing. You absorb the entire cost. And here's the part that should make you pause. Your employer is not required to tell you this is happening. No letter, no call from HR, no line item on your offer letter. You will see it on your W-2 after the fact, if you know where to look. For most people, it shows up as a small, unexplained reduction in take-home. They chalk it up to some adjustment they do not understand. It has been quietly running since 2013. That is layer 1 of the stack. The second layer is the net investment income tax. NIIT. The rate is 3.8%. This one does not hit your wages. It hits your dividends, your capital gains, your rental income, and anything the IRS classifies as passive investment income. The trigger is your modified adjusted gross income crossing $200,000 as a single filer. Say your W-2 income is exactly $200,000, and you also have $30,000 in dividends from your brokerage account. You do not simply owe tax on those dividends at your ordinary rate. You owe an additional 3.8% on top. Your MAGI exceeds the threshold by $30,000. The NIIT applies to the lesser of net investment income and the MAGI excess. In that scenario, the extra charge is $1,140. Silent, not on your pay stub. It shows up on Form 8960 when you file. What makes the ENI punishing is not the rate. It is the threshold. That $200,000 line has not moved since 2013. Never adjusted for inflation. Not once in 13 years. When Congress wrote this tax, it was designed to reach a specific slice of very high earners. But wages have risen. Asset values have risen. More people cross 200,000 in nominal terms every year, even when their real purchasing power has barely moved. Imagine a bar. It represents the pool of taxpayers inside the NIIT. In 2013, that bar held 3.1 million people. By 2021, it had grown to 7.3 million. The revenue the tax collected climbed from $16.5 billion to $59.8 billion over the same period. The bar just kept growing. The threshold stayed fixed. More people walking into the same tripwire year after year because the wire never gets raised. What was designed to reach the top of the income distribution has quietly moved its way down into the professional middle class. Engineers, lawyers, mid-level managers in tech. The doctors finishing residency and finally hitting their earning years. That is the audience this tax now reaches. Marcus is a 38-year-old software engineer. He hit $210,000 in W-2 compensation last year for the first time. He also had $25,000 in long-term capital gains from an index fund he had been building for a decade. He knew about brackets. He'd done enough reading to know the jump to 32% does not happen until taxable income crosses a higher line. He figured he was fine. What Marcus did not know was the NIIT. His Maggie was $210,000. That is $10,000 above the threshold. His net investment income was $25,000. The tax applies to the lesser of those two numbers, $10,000. 3.8% on $10,000 is $380. Not catastrophic on its own, but Marcus had no idea it existed until his accountant flagged it in April. He also had not noticed Layer 1, which had been pulling an extra $90 per month from his paycheck since October. He had assumed it was a routine correction. 2 charges he did not expect. 2 forms he had never filed. 0 notifications from his employer about either one. That is the invisible stack in practice. Marcus looked at his tax bill for a long time that April. He had done everything right. He maxed his 401k. He held the index fund for years. He did not day trade. He did not speculate. He built something steady and patient. And the reward for crossing that line was 3 charges layered on top of each other. None of them appeared on any document he had been handed when he accepted the job offer. He was not doing anything wrong. The system just never told him where the wires were. If you have ever looked at your take-home pay after a raise and felt like the math did not add up, you know the feeling. That is the invisible stack. Not bracket confusion. Not withholding delay. 3 actual charges, compounding your obligation at the same invisible threshold. Now the 3rd hit. This one does not show up on any pay stub. You only find it when you go to use a tool you assumed was still available. At $200,000, the door in the Roth IRA closes completely. For a single filer in 2026, the full Roth IRA contribution is $7,500. You qualify for that contribution if your Maggie is below $153,000. Between $153,000 and $168,000, the contribution phases down proportionally. Above $168,000, you are locked out. No direct Roth contribution. 0. $200,000 is not near the phase-out zone. It is $32,000 above where the door already shut. If you just crossed $200,000, the Roth closed while you were still climbing toward it. You may not have noticed because everything else in your financial life was accelerating at the same time. But the account that grows tax-free, compounds tax-free, and distributes tax-free in retirement stopped being available to you somewhere on the way up. Gone. And the traditional IRA deduction went even earlier. Covered by a workplace plan and earning above $91,000 as a single filer, that deduction is 0. Not reduced. 0. So the Roth is closed. The traditional deduction is gone. The two shelter tools most Americans use alongside their 401k are effectively unavailable at your income level. Picture two columns. The left column is what you gain when your W-2 crosses $200,000. A larger paycheck, more leverage, more options. The right column is what disappears at the same moment. Direct Roth access, IRA deductibility, and two new charges quietly attaching to the income you just earned. Most people only see the left column. Nobody shows them the right one until April. At $200,000, the invisible stack is complete. You gained income. You also gained a Medicare surcharge you did not consent to and cannot negotiate. You gain an investment income tax on the dividends and gains you worked to build. And you lost the most flexible tax-free vehicle in the American retirement toolkit. The instinct is to say, I am making more money, I can handle it. And you can. But that is not the point. The point is that none of this was explained to you. The system is not designed to flag these three things when your W-2 crosses a line. You are expected to discover them through an accountant, through a painful April surprise, or not at all. I know what the skeptics are thinking. 0.9%. How much can that actually matter? Run it out. You earn $250,000. The ante applies to the $50,000 above the threshold. 0.9% on $50,000 is $450 a year. Over a 30-year career at that income level, no wage growth assumed, that is $13,500. With even moderate raises over that span, the aggregate is meaningfully higher. The dollar amount is not the main issue. The principle is. You are being charged a rate your employer never disclosed. A surcharge Congress created in 2013 to fund the Affordable Care Act, never indexed to the inflation that quietly pulls more workers across its trigger every year. The objection that comes next is this. Just avoid investment income. Stay inside the 401k. Skip the brokerage. NIIT, problem solved. That works to a point, but it means locking more of your money into accounts with restrictions and no flexibility before retirement age. And it does not touch layer 1. The additional Medicare tax hits wages directly, not investment income. It also does not reopen the Roth. The lockout is based solely on what you earn, not what you invest. The invisible stack is not a conspiracy. Three separate pieces of tax legislation, written at different times for different purposes, happen to converge at $200,000 for a single filer. The IRS did not design this to catch you, but it catches you anyway. Now let us talk about what to do. Step 1 is to update your W-4. You cannot direct extra withholding specifically toward the AMT or the NIET, but you can request a flat additional dollar amount withheld each pay period. If your investment income is meaningful and your MAGI is above the NIT threshold, you want to preempt that April bill before it arrives. Your payroll portal has the line. A CPA can give you the right number in about 10 minutes. Step 2 is to track your MAGI as a live number through the year, not a year-end discovery. MAGI is not just your salary. It includes dividends, capital gains, rental income, and certain deductions added back. Every dollar above $200,000 is a dollar potentially subject to the NIIT, tax loss harvesting. Timing of asset sales and maxing your 401k contributions all reduce MAGI directly. Your own contribution of $23,500 drops your MAGI by that full amount. That is a real lever worth pulling before December. Step 3 is to replace the Roth with its equivalent. Direct Roth contributions are gone at your income level. The backdoor Roth is not. You contribute to a non-deductible traditional IRA, then convert to Roth shortly after. If your traditional IRA holds no pre-existing pre-tax money, the pro rata rule does not bite you. More mechanics than a direct contribution. Same outcome. $7,500 per year going into a tax-free account, compounding without generating annual NIIT exposure on the growth inside. Do not leave that door closed just because the front entrance is locked. Think about what the invisible stack actually costs in something other than dollars. At $250,000, the stack runs roughly $2,000 annually between the AMT and any height on a moderate portfolio. That is about 3 days of your working year handed back to the Treasury. 3 days you showed up, did the work, earned the pay. The 3 steps above take 1 conversation and 1 afternoon. That afternoon buys back those 3 days. Every year from here forward. If this resonated and you are in that 35 to 45 earning range, subscribe to Salary to Strategy. If you're starting to feel the ceiling on your take-home, this channel is built for that conversation. We publish one of these every week. For the people standard, financial advice was not written for. When someone tells you that a raise to $200,000 is going to change your life, they are right. It will also change your tax return in ways HR will not mention in the offer call. 3 mechanisms, 3 forms, 1 threshold. The invisible stack is real, it is legal, and it has been quietly running since the first year it applied to you. Check your withholding. Know your Maggie. Keep the backdoor Roth alive. That is the protocol. One more thing before you go. Those people who cross $200,000 tell themselves they will deal with the tax complexity later. Next year, when things slow down, when there is more time. But the AMT does not wait for your schedule. The NIIT does not pause while you figure out your Maggie. And the Roth lockout does not reopen just because you finally got around to asking about it. The invisible stack has been running since the first paycheck that crossed the line. The only question is whether you are going to run the plays above before next April or discover the bill after it. Drop your income range in the comments and tell me which of these 3 you did not know about before this video. No need for specifics. I am just curious how common the blind spot is. I will see you in the next one.